Okay, hi guys, welcome to the sharpening session today. So today is obviously a Saturday, most markets are closed, so we do sharpening sessions on days like this where we can go into methodology a little bit more, answer questions, go through some theory, things like that. I normally have a topic in mind, but as you'll see, where it says here, I keep losing my mouse at the moment, there it is. As we see here, it says Q&A. So these are sessions ultimately for you guys to ask questions, let us know what you're struggling with, what's confusing, what do you need us to explain more, what do you need us to clarify, and if nobody asks any questions, then I'll go into a theory or a topic of choice that I'll just pick to go through. So my name's Becky, for those that might be joining us for the first time. So my name's Becky, my email address is there, becky@traddictiv.com. I know my head is in the way. If I move it a little bit, perhaps you see it there, becky@traddictiv.com. Also, and preferably, there's this link here, which is tradewithufos.com/Becky. Let me just bring that up. Move that out of the way. Okay, so this link here will take you to this page, and here you can set up a free Trade with UFOs membership. That will get you things like recordings of these sessions, reminders of these sessions, an email every day where you'll get information on 5 major world markets. You'll also be able to, if you want to, book one-on-one coaching here. But for me, the most important bit is this bit, which is you have access to be able to ask questions in a public space. So to me, if I get questions on an email, of course I respond to them. But if I get questions publicly and I answer it publicly, other people see the answer. So it helps others that are also perhaps confused about the same thing or want something else cleared up. It's all there for everybody to see. If you scroll down a bit, there are questions that people have already asked and the answers will already be there. So it might be that the question you have is already, the answer is already there for you. If the question you have is not there, then if you can, please do it here so that we can answer it there and you're helping somebody else out later down the line on that as well. Cool, so let's just make sure we cover the disclaimers because always need to make sure that we do that. So there we are. Cool. So disclaimers are being highlighted there at the top. Of course, it's important for legal reasons that we show them and that you read them, but also to understand that these kind of videos, whatever they are demonstrations of how we do things and how we think about the markets, not to say you have to do anything about that. You could ignore us entirely and do whatever you want. You could take it on board entirely, you could do something in between. Ultimately, your choice as a trader to decide what it is that's right for you, what makes the most sense to you. And on these sharpening sessions, a lot of the time, my sort of goal, my idea of these things is to reinforce this, is to go through different things that you can do so that you can decide what's best for you. I'll explain this more as we go more into whatever topic that we go into today, depending on the questions that we get or whether or not I just go into what I was going to cover. When we're trading, we are looking, there are no two traders that are looking at the exact same market on the exact same time frame, at the exact same time of day, with the exact same amount of money in their accounts, with the exact same risk tolerance, using the exact same strategy and methodology. The chances are like millions to one that would be the case. We are all individual traders that have different variables based on things that we might not have control over. Time and money and the way we think and our psychology and things like that. So it's okay to do something slightly different to somebody else. There's no way you're going to do exactly what they do at exactly the same time of day in the exact same way. So that's okay. So my job in these sharpening sessions is to show you different things that you can do and explain that and what style might suit a particular person, what time frames might suit a particular time of day, what risk tolerance or what risk management techniques might suit somebody who's more or less conservative, so that you can go, oh, okay, that suits me more. Don't like that bit, but that suits me more. And that's ideally what I want you guys to do, is to build a strategy that suits you specifically, because it makes sense to all of those variables that are yours. So hopefully that makes sense. Right, so I will give you guys just a couple of seconds to write in the chat box. Give me just 1 second. Having a tech thing, so give me a sec and I'll be back there. Hold on. Okay, cool. There we go. That should be working. So I know we've had tech issues in these last couple of sessions that we've done. Apologies for that. Today should be fine. It was a quick camera thing, but today should be fine, which means we should go for the full length of the session. So let me just explain how this goes. So we are simulcasting, meaning we are streaming in different platforms at the same time. We are within our closed coaching community. We are on Facebook, we are on YouTube. So the people that are accessing on Facebook and YouTube, obviously you're accessing it for free. The coaching community, they access our sessions and they pay $21 a month. Now you might think, well, why would anybody pay for it if it's free on YouTube or Facebook? Good question. This is how we do it. At some point during this process, during this class, we will cut off the live stream so that we are only streaming inside our closed community and we won't be streaming on Facebook and YouTube anymore. So the people that pay $21 a month get access to more of our time in a closed environment. That's the difference. So at some point, for those of you watching on free channels, it might be that we finish a particular point and we stop streaming from there and we continue on a different point. When we're doing our live trading sessions, it might be that we place one trade or two trades and then we cut that off and then we continue looking for other trades after that. So that's kind of how it works. So that's what we will be going through today. So again, you guys let me know any questions. I can't see any come up, which means I'm going to go into a particular topic of my own, I guess. So you might have joined us in the last couple of sharpening sessions, and I know they've been cut off early and I haven't been able to really expand on things properly because of my tech problems, which is on me, my bad, sorry guys. But now that we have a little bit more, should have, as she says, fingers crossed, should have a clear run today, we are going to kind of go over what I half went into on previous sessions and expand on it. So what I'm going to do is bring up TradeStation. There we go. I'm going to bring up TradeStation, and you might have noticed in a lot of my sessions, I have this floating percentage. Now I have this floating percentage there for a reason. It tells me ultimately what the probability rate is. That's a very rudimentary way of explaining it, because what it really does is tell me how many times price moves between UFOs. In this case, these UFOs are really, really far apart, right? So it'd be great if it moved between those and we caught that entire move. But what it's showing me is how often price moves between the UFOs on that time frame that we're looking at, on that market that we're looking at, loading that amount of bars that we're looking at. Very, very specific. Which means we're on a 5-minute chart right now. If I was to change this to a 6-minute chart, that number should be different. And there it is, different. If I change it to an 8-minute chart, it should be different. There it is, it's different. We're looking at the euro dollar. If I look at the pound dollar, that number should be different. There we go. So hopefully you've seen these numbers have gone from 43 to 52 to 50 to 40 something, 44. There's a reason for that, because on each time frame and on each market, you're going to have different stats, different probabilities. So that might be a little bit confusing if you think, well, hold on, I do one strategy. For example, I use UFOs, and I use UFOs on 20 different currency pairs. But maybe some currency pairs have a lower percentage rate, and that might bring down my overall profitability. That's true, that could happen. In general, as long as you have this over, I personally would say over 40%, it should be okay. Because yes, it's moving between UFOs, and yes, sometimes those UFOs, you could have one that's like this, perhaps. There we go. What do we want? I need to do it a different way. Is it just that? There you go. We might have one that looks like that, and then a sell UFO literally right above it. That's like this. She says, I'm getting weird with my mouse. There you go. In which case, price moving between here and here is like 0 point something to 1. That's not a profitable strategy to hit tiny percentages 40% of the time. But what if they're this far apart from each other? What if they're 20 to 1 away, 10 to 1 away, 5 to 1 away, 15 to 1 away? And you hit that 40% of the time. That's great. So this number doesn't necessarily reflect your profitability rate. It reflects your probability rate. And there is a difference between those two. You could be right 90% of the time. That number could be 99%. But if you risk 1 to make 0.001, even if you're right 90% of the time or 99% of the time, you're still going to lose money. It's going to be slow, but you're going to lose money. Because when you're right, you make a tiny amount, and when you're wrong, you lose a lot. So you only have to be wrong once in amongst loads and loads of right trades in order to lose a bunch. So Yes, probability is a good thing. The higher that number, the better. But it's not necessarily reflective of your profitability because it's taking into account UFOs that could be very far apart or very close together. Now, understanding how far apart UFOs are is something that comes from backtesting. Our UFOs are showing us where we have stacks of buy and sell orders in the market. They are not at set ratios away from each other. They are in particular places based on where big stacks of buy and sell orders are, which is where banks and institutions mostly want to be trading. They put it, random places, whatever their analysis has told them, or it might be big stacks of buy and sell orders that have come from retail traders perhaps. And there's just loads of them in one place. Why? Who knows? There could be loads of reasons. And so we don't have a crystal ball or any metrics really to say UFOs are 2 to 1 away from each other. And therefore, if that's more than 30%, you're okay, or 33%. We don't have a stat that says UFOs are averagely 5 to 1 away from each other. You could get that number, but it would be based on so many anomalies that it doesn't really give you a good percentage rate. So, for me, I think as long as this is 40% or above, we are only going to be going for trades that are minimum 1 to 1, and most of the time we're going to be having our final targets 2, 3, 4, 5, 10 to 1 away. Which means being right 40% of the time, roughly, should work out for you. So, if you have UFOs on TradeStation, you can use this number to then help you refine things down. So remember I was saying right at the start that when we're trading, we should be understanding our own variables. Meaning, am I somebody that's extremely risk tolerant? Meaning volatility is great, I'll place a bunch of trades, my percentage per trade is high that I'm risking and I'm comfortable with it? Or am I somebody that's completely risk averse? And I'd rather, out of 10 trades, I'd rather be right 9 times, even if it's small, than be right and win a lot, but I only have to be right 2 times out of 10. Couldn't handle that, right? Am I a person that wants to just be consistently right, and then if I'm wrong, I lose a bit more, but I'm right more often? Or am I a person that wants to be taking the long-term trades, riding it out, and being comfortable with that? Those are things that are fundamental about you as a trader. Do you want to place loads of trades and reduce this number? Or do you want to place fewer trades and maybe increase that number? Are you impatient? Are you patient? Are you impulsive? Do you want things to happen quickly? Or are you okay to wait for the long game? These kind of things are down to you. Forcing yourself to be the opposite does not work, trust me. If you are risk averse and you try and make yourself embrace risk and become very risk tolerant, that's not going to work because you're pushing your fundamental psychology and personality to be something it's not. And vice versa. If you're somebody that's extremely, risk tolerant, you're happy to place loads of trades and you want things to be happening quickly, and somebody tells you need to place 1 trade a month and wait, you won't. You'll break the rules. So understand those things first. And then, in order to find the methodology or the specific markets and timeframes that suit that, you can use this number to really help you refine it. So I'll give you a couple of examples. And again, you guys let me know in the chat box if you have any questions. Oh, I've seen one come up there. Hi there, Mark. Missed that. Do I trade futures? I do trade futures. I don't so much at the moment because I've been living in Mexico for the last 6 months. So my timings are off. I'm not in my usual sort of structure and habit of time allocation. But yes, I do trade futures, not actively at the moment. But yes, I do in general. I know you've had to leave there, Mark, but hopefully when you watch the recording, you'll get the answer to that, or you can email me, as you know. Okay, so using this number, let's say, for example, we've decided to trade, let's do futures, since that was a question there from Mark. And again, you guys let me know in the chat box if none of you trade futures now that Mark's left and you want to look at Forex pairs or you want to look at stocks, let me know that too. But let's take futures as an example. So let's say we are trading, let's be very, very stick to the grain here and look at the ES. So the ES being the futures contract, continuous futures contract for the S&P 500. Now, let's say we trade the ES. You might be thinking, okay, I want to trade timeframes between a 1 minute, I'm day trading, right? In this example, I'm day trading. I want to trade timeframes, maybe a 1 minute, maybe a 2 minute, maybe a 5 minute, maybe an 8 minute, maybe a 10 minute. I want to trade up until that 10 minute time frame. Which one's going to be the right one for me? But all you need to do is bring this up, and you bring that up on your UFOs by just double clicking on the edge of any UFO, click yes, and you'll notice here that we have show UFO stats, true. Now, by the way, I'm just going to change my calibration here. I was playing about with that on the last session we were looking at. I'm just going to put it back to 0.5. I'll come back to that later on today. So we have show UFO stats. You just need to type over it and say true. Click OK. You'll notice, by the way, since I've changed the calibration, things have changed here. But it wouldn't do that if you didn't change the calibration. So we are now showing the specific stats that show us 65.93% of the time on an 8 minute chart on the ES loading 500 bars for the last 500 bars worth. So for the last 500 of our candles, price has moved between UFOs. Those UFOs could be very close together, they could be very far away. With a 65% probability rate, even if they were less than 1 to 1 away from each other by a little bit, you'd still make money. If they were averagely 1 to 1 away from each other, you'd still make money. So we look at that number and we say, great, on an 8 minute chart, it's 65.93. What if I looked at a 5 minute chart and you just change that variable? So now we've changed and we've looked at a different time frame. This has gone to 66.23. So it's gone up by a little bit. And you'll notice the UFOs are in different places. There's not as many, because we're looking at a different time frame. I know it's only a 3 minute difference, but when you're day trading, those timeframes do make a huge difference. Let's say you say, right, let's go through from 1 minute to 10 minutes. So you start at 1 and you look at that and you go 68%. That's even higher. 68% of the time the ES is moving between UFOs. Great. 2 minute chart. So far the 1 minute chart is winning. The 2 minute chart is now winning. That's 72%. So you just go through and you'd go, right, so far we've looked at the 8, the 5, the 1 and the 2. We'll go through it in chronological order, make a bit more sense. So far the 2 minute chart is what's showing us that we have greater probability. We'll go to a 3 minute chart. That's gone down now to 61. Great, ignore that. We're still with the 2 minute chart so far. 4 minute. Great numbers. These are great. For me, it's minimum 40%, so these are great, but the 2 minute was still the highest. 5 minute doesn't beat the 2 minute. 6 minute doesn't beat the 2 minute. 7 minute, and you get the point. So this one's come up to 70%, so a 7 minute chart has come up to 70%, but the 2 minute chart was a 72%. So far, the 2 minute chart is winning. 8, and then we'll do 9 and 10 again, just to kind of show the point. Again, not high enough, doesn't beat the 2 minute, still doesn't beat the 2 minute. Let's go to the 10, see what happens there. Still doesn't beat the 2 minute. So all of these are decent percentages, to be fair, but out of those 10 different timeframes that we just looked at, the 2 minute chart won. So if you're weighing up between, okay, I know I want to be a day trader, but there are still loads of different choices that I have in terms of which timeframes to trade, you can use this to look at different timeframes and say, which one has this number the highest? In this case, it was the 2 minute chart. Let's go back to it. The 2 minute chart would give us the highest percentage. And so you might decide that's the one I want to be on. Now, if you're a swing trader or a position trader or a investor, the 2 minute chart is nowhere near what you should be looking at. You should be looking at bigger time frames. So let's say you're trading stocks instead of futures in this case, and you are investing. Let's go to the SPY. Futures is normally used for day trading. Not to say you can't do longer term stuff there, it's just normally better used for day trading. So the SPY, which is the ETF, so again it's like a stock that represents the US stock market, or you can invest in an ETF, invest in this group of stocks, and it represents the lot. So on this one, yes, the 2 minute chart's still good, but let's say you want to invest. This is for your long-term stuff. This is for your 401ks or your pensions or whatever you look at. You want to be looking at maybe weekly charts. and looking at that and going, okay, weekly charts, 49% of the time it moves between UFOs. It's still above 40, still something that I think would be good enough. You might be more strict here. Again, this is up to you. You would decide which number is the minimum that it has to be. You might say, okay, weekly charts for my entries. What if I got in on daily charts? What happens then? Went from 49 to 35. So that's quite a big jump down. So you might go, okay, in which case my investing, I look at weekly charts to do that. You might want to use Fibonacci numbers and go to a 377 minute. See what happens there. That's even less. In this case, in particular, this particular time frame on this market doesn't do very well there. You might say, okay, what about a 4-hour chart? That might be the lowest you might possibly go. So 240 minute. What does that do? 44. So far our weekly had a better probability rate. So it's not to say that you go, oh, but the 2-minute has a 72%, so I'm going to invest on the 2-minute chart. That's not how it works. Out of all of the time frames, if you think each minute is a different time frame, I think there are 1,480 minutes, I think, in a day. That gives you 1,480 different time frames to look at. You can't just look through every single one of them and go, right, I'll pick the one that has the highest number, and then make yourself be a day trader when you don't have the time, or make yourself be a swing trader when you're less patient, or make yourself be an investor if you don't have the capital or the time to wait. Those things come first, and then once you've decided I'm going to be a day trader, then you can play about within the time frames that make more sense for a day trader to get that number where it needs to be. Once you've decided, yes, I'm an investor, then you can play about with the time frames that make more sense for you to get involved in investing. Don't let that number by itself dictate what you do. First, figure out your style of trader based on your variables, time, money, goals, all those things. And then amongst that, play about with it until you find this right number. Now that's using time frames. So what I'm going to do is just explain quickly using different markets. So let's go back to futures. We were looking at the ES. And let's go back to day trading time frames. Since we're on futures, it makes a bit more sense. We'll do that. 2-minute. Okay. So this was the one that we were on. Our 2-minute chart for the ES had a 72-point-something% probability rate. So as long as they are, I can't do the maths on that, but point something to 1, 0.7 to 1, 0.8 to 1 returns. So you can be risking that to make that. Because of the probability rate, you'd still make money with that. What's great with this is, let's say that probability rate is 72% and you still get 1 to 1s, 2 to 1s, 5 to 1s, 10 to 1s. That's even more juicy, right? So again, the higher the number, in theory, the better. So let's say you're going, right, let's say you're day trading, you say I've got $10,000 in an account. And the margin that's tied up when I place these trades means that I can only place, 3 or 4 trades per day, or 5 or 6 trades per day. Depends on the markets that you trade and the margin that's tied up. So out of the maybe 30, 40 decent markets, liquid markets that you could be trading on futures, and I know there are many, but let's say 30, 40 you could look at. You don't want to be looking at all of them if you can only place 5 trades, let's say 5 trades. So you might be looking at it and going, how do I know which markets to trade? How do I know whether I should be trading soybeans or cocoa or coffee or orange juice or the ES or the NQ, or maybe I should be trading oil or natural gas or gold or copper or silver or platinum? How do I know? I have the choice as a futures trader to day trade any one of them. So which do I pick? Again, this comes in really, really useful. So if we're looking at the ES, you might say, okay, I'm going to pick 2 of my index trackers, or my stock futures of stocks, out of the main 4. So I'm going to look at all of them. So you might go, okay, so far the ES is winning on that. Let's go to the NQ. The NQ on a 2-minute chart has a lower number. But maybe what you might do is go through 1 to 10 again and see whether or not you get a decent number out of those, and see if it gets to be higher than 72 or around that. So you might go here and go, right, 1 minute chart, 61%. We want to try and get something towards 70 so that it's on par with our ES. So I'm just going to scroll through here until we see that number get to 70. It might not get there, in which case we might say, okay, we don't look at the NQ. In this example, that's not to say don't trade the NQ or it's not good enough. These numbers are great. If you're already trading it, you're probably already doing well if you're using it. I'm just giving an example of how you might use this to filter out different markets. So I've just gone through it again, time frames 1 to 10, just to be very, very rudimentary there. None of those numbers got up past 65, 66%. So far you might go, okay, out of the ES and NQ, if I had to choose between the two, I'd trade the ES because I have higher probability on one of those time frames. What about the YM? So let's have a look at that. And you do the same thing. Back through 1 minute to 2 minute. Bearing in mind that NQ got us about 66%. So we'll bear that in mind. 3, 4. Notice I'm very quickly looking. It doesn't take very long. I'm looking for this number to get above 66%. 5, 6. So far it's in the 50s. This one's 64, so that's decent, but still not as high as the NQ so far. And again, these numbers are great, to be honest. They're not numbers to be sniffed at, of course. Okay, so going through the YM, 1 minute to 10 minute, we didn't quite hit what the NQ did. So far, if you've looked at 3 and you're going to pick 2, you might say, right, ES, NQ, those 2 win. And it's based off of purely objective data. That number doesn't care what you think about those markets or how you subjectively feel about it or what's going on in the news or what's going on in the world or how it interprets the economy. That number is just a plain statistic that says this amount of times is when you'll get price moving between UFOs. Now, as I said before, that number could be 20%, but the UFOs are hundreds to 1 away from each other, in which case ultimately that makes more money. That number is not necessarily reflective of profitability. It's reflective of probability, how many times you're right, essentially. But let's just do this really quick on this maths here. And by the way, guys, you're a bit quiet in the chat today. I know we've had Mark said something on the close thing, but you guys let me know if this is boring, if this is making sense, if it's not. If there's a particular market you want me to run this through whilst we're here, you let me know. I'll just explain very quickly about the difference between probability and profitability, and then I'll carry on with these examples of looking at different markets. Then I'll cut the stream and we'll carry on and look at calibration and how that works. Okay, so I'm going to carry on and keep my eye on the chat box if you guys have anything to add or change or suggest. So let's try and find a bit of blank space here just so it's easy for me to work this out. So let's say you are right 20% of the time, and over here you're right 70% of the time. Okay, here when you're wrong you lose $1. And when you're right, you make $10. So you have 8 trades. Let's say you place 10 trades in each of these. You have 8 trades, and you've lost, so it'll be minus $8. Over here, though, you've had 2 trades that have gone well, and you've made $20. So overall, you're up. Go back here. Overall, you're up $12. Okay, that's if you're 20% right. Now, with 70%, and we might squish it a little bit here, so we'll try and be really tight with this. With 70%, let's say when you're, let's do the same thing. Let's say when you're wrong, you lose $1, and you're wrong 3 times. So 3 times minus $1, we'll keep that number there, is minus $3. So we save space, right? Let's put this line down here, and we'll put that like that so we know we're using these same numbers. Okay, so if you're wrong 3 times and you lose $3, not a big deal. But let's say when you're right, instead of making 10, you make 50 cents. don't have the space for that. Let's say you make $1 and you're right 7 times, which means you've been right 7 times 1 and you've made $7. So overall, you've risked the same amount. Overall, you're still up $4, so you're still profitable. Overall here, yes, you were right more often. Your probability rate was higher. But because of what you make when you're right versus what you lose when you're wrong, you're still profitable, but you only made $4. Over here, you're not right very much at all. You're wrong 80% of the time. 80% of your trades lose. But when you're right, you make a lot more and you're up by more, 3 times more. So, profitability and probability are different things. However, if we assume that the reward to risk ratio is going to be roughly the same on different markets, different time frames, because UFOs are all over the place. On any chart, on any time frame, on any market, they could be very close together or very far away. No market is going to have ones that have a particularly skewed reward to risk ratio compared to the others. If it does, it's an anomaly. It doesn't, it just happens that way. So if we assume that the reward to risk ratio is the same, roughly, then of course the higher the percentage of probability, then the higher the profitability. But not always. Depends on this bit, right? Depends on how much you make when you're right. No, that's really messy. It probably would have been even worse if I'd have drawn it by hand, but you get the picture, hopefully. So let's say you've gone right. I've looked at a few of my stocks. Let's have a look at oil. And you do the same thing and you just look at another market. So you look at oil and you might do the same thing, and you filter through these 1 minute time frames, 1 minute intervals, trying to find something that's greater than 66% to compete. So this one so far, 67, 4. You might write it down, keep it on a spreadsheet or something like that to make it easier to see. 6, 7, 8, 9. Okay. So far, again, great numbers. They're all in the 50s, 60s. So again, decent numbers. But you might be saying, do you know what? Compared to the stock ones that were 66%, 72%, I might leave oil for now. Maybe make a record of the highest number on the highest, on whichever time frame it was that gave you that highest number. And then look through, you do this once. Look through the 30, 40 choices that you have and eliminate ones that are not as high as the others. So again, hopefully that makes sense as to how you can use this to really filter down what markets you look at. A lot of the time we choose markets to trade based on what we think about something, right? Especially stocks. People will buy stocks because they buy Tesla because they have a Tesla. I know Boyan always says he might be a little bit biased with that because he has one and he loves it. If you're trading, I don't know, I love Disney, so I probably would be more interested in a Disney stock. But the stock market does not care what I like, what I drive, what films I like to watch, what phone I have, whether or not I buy an Apple share or not. The subjective ways that we think about getting into the markets doesn't help us, because the markets don't care what we think. They care what objectively happens. They care where buy and sell orders are. They move based on these numbers, based on probabilities over time. So to me, I would much rather, if I've got 30 different things to look at and I have to pick 5, I would much rather use something like this to whittle them down, rather than, well, what do I think about oil? What do I think about natural gas? Do I think that lean hogs or orange juice or coffee or cattle have a particular future, and make subjective decisions? I'd rather use this number to filter that down. So, giving examples of how you may use it on different time frames to get that number where you want it to be. Examples of how you might use different markets to get that number where you want it to be. To give you an idea of what markets should you be trading based on your criteria that you've already filtered it down on. What time frame should you be trading based on criteria that you've already filtered it down on. What you don't want to be doing is going, right, I could trade stocks, Forex, futures, options. I'm going to look through every single market and every single time frame to just pick the one with the biggest number. That, first of all, it would take you months, I would think. It would take you a very, very long time. And secondly, you might end up trading futures that might work better on day trading and trying to pick a investing time frame when actually your personality and the time you have best suits swing trading. Get those answers first. What asset class overall? Futures, forex, stocks, options. Which of those suit you best? If you struggle with that, you can reach out to us. We can help you figure that out. Which one of those suits you best? What style suits you best? Day trading, so quick in and out. Swing trading, trades last a few days to a few weeks. Or position trading or investing where it's lasting a few weeks, few months, few years. Pick your asset class, pick your style, and then you can use this to filter it down. Hopefully that makes sense. Seen there a question there from Fabero. So how we create that percentage. So this comes from the UFOs. So probably you're looking at the Trade with UFOs channel. I would think it might be the Traddictiv channel, but Trade with UFOs, that means we use this app. So these little boxes that I have here on the chart, these are our AutoUFOs. On TradeStation, it's $89 per month. This feature doesn't exist on the TradingView version. That's one of the reasons why they're different prices. On the TradingView version, you don't get this percentage. On TradeStation, if you have the UFOs on TradeStation, all you do is you double click on the edge of any UFO, click yes, and then where it says here, show UFO stats, this bit, just type over it and say true. So it might say false, just delete that and type true. And then that percentage will show up. And then every time you change a time frame or a market or calibration, it will give you a different number. So hopefully that makes sense as to how you do that. If not, if you don't have if you don't have TradeStation and you don't have AutoUFOs, or you have one but not the other, it doesn't matter so much. This number is not absolutely crucial. You can still, as you saw, nearly everyone that we looked at had more than 50% probability rate. That's good enough. Again, that's 50% probability rate assuming that you're using the UFOs, right? Assuming that you're doing it in that way. But what's really, really great about this is if you follow us and you understand the methodology, we don't just go, right, let's look at a chart, let's put a sell order there and a buy order there. That's not what we do. We increase those probabilities by using our AutoClimate, which is a free app, by the way. So whether you're on TradeStation or TradingView, that's a free app. You can download that and use it for free. Whether if it's thick blue or thick red, these dots, it will tell us where we have probabilities up or down. So let's say 60% probability rate that price moves between UFOs, but this has probability downwards. Well, then this one has higher probability because it's sell orders in a downwards market. They work better. Buy orders in a downwards market tend to get cancelled. Sell orders in a downwards market tend to be stronger. So that number is a baseline, absolute baseline. So add in climate and follow the climate with the orders that make sense to follow the climate with, you've increased that number. Add EMA, which is another element of our methodology, which adds buy or sell orders depending on what we're doing, then you've increased that number even more. That might go up to 70, 80%. Might stay around 61, 62. It might not have made a huge difference. But that number is the absolute baseline because that's assuming you just trade UFOs between each other. That's assuming you have no other methodology. It's assuming that you don't risk manage, or that you don't take certain targets along the way, or that you don't move your stop, or that you don't have trailing stops. It's assuming nothing else than you just played them between each other. So if those numbers are 50%, 60%, baseline, great, because add in all those other stuff and you're increasing that probability rating even more. So when we're thinking about this, when we're looking at our UFOs and we're thinking about whether or not we're going to trade certain things, let's say you have UFOs on TradingView and you can't see this, most of them are going to be okay. You've seen from the different markets I've looked at. Once you're adding in these other percentages and these other variables that increase probability, again, it doesn't matter so much. But if you do have TradeStation and you do have UFOs on TradeStation, this is an additional thing that you can use to make that even more objectively, this has the best probability. Or if you want to, you can backtest these things yourself and get that data by backtesting it. Essentially, this is a software that's backtesting it quickly for you. and saying this is the number. But if you don't have it, you can either do $89 a month and get that number, or you can backtest it yourself and go through TradingView and collect that data yourself and find out what that average number would be. I use TradingView, so it's not showing. Yeah, okay, so it's always the zone showing by the UFO is less than 50%. Okay, is it always the zone showing by the UFO is less than 50% of the body candle? Could you expand on that a little bit? Apologies, it's probably me. I'm not following exactly what you mean there. So when you say of the body candle, do you mean of the candle that leaves that area, or do you mean the candles within that area, or what do you mean there? Or are you referring to this number? Because this number is to do with the percentage of time that price moves between the UFOs. Yeah, let me know. I'll keep an eye on that chat box. Let me know what you mean by the body candle, which candle you mean, and then I'll answer that if I can. So just to expand whilst you're typing that, let's say, for example, on this particular chart, let's assume we only ever had 2 UFOs on this chart. Then what this says is that 60% of the time price would hit that and then hit that. Or 60% of the time price would hit that and then hit that. That's all it does. That's all it says. Let alone adding in these other probability ratings that say, actually, this one's probably more likely to work in a downwards climate. In an upwards climate, this one's more likely to work. Oh, the EMA coincides with this one, so that has even better probability. Oh, no, the EMA coincides with this one, that has better probability. These are other layers that we put in that give us these probability ratings. And again, if you have it on TradingView and you don't want it on TradeStation, you can backtest it yourself to figure out what those numbers are. How often you would be hitting target, or how often you would be hitting opposing UFOs over a certain period of time. It's more time consuming for sure, but it's free. You know, you can do that. You don't have to pay anyone to do that for you. You can figure it out yourself. I'll keep an eye on that chat box just to see what you mean there, Fabero, by the 50% of the body candle. I'm just going to reread it again, see if I can, maybe I read it wrong. Is it always the zone showing by the UFO is less than 50% of the body candle? So, for example, this one, I'm not sure if you mean the 50% of the body candle. These two, you can't see it very well. It's probably better on this green UFO to show you better. This green UFO, you'll notice there are wicks in here. So it takes into account the wicks. It's not just doing body, if that's the question. Sorry if I'm not answering that very well. I'm not sure exactly what you mean. But the zone, the UFO will show you a zone that includes wicks. Okay, so we are coming up to where I should be cutting the stream and continuing in our closed environment here. I'll round up. I'll probably try and elongate this a little bit here for Vera, just in case you have you want to clarify that question. Oh, I'm seeing here. The base candle that's showing pointed by the UFO is less than 50% of the wick and the body. The base candle, so this one that's showing pointed by the UFO. Okay, so do you mean that the candles within that area, within that zone, have more wick than body? If that's what you mean, then you are correct. Then that will be the case. The candles within our UFO zones, within those UFO, so like this one, you'll see the candles that are within that zone are, yes, more wick than body. I think that's what you mean. The base candle, so the base candles would be the ones within here, definitely, within these little areas. Base candles shown by the AutoUFOs, yeah, 50%, yes, definitely. Cool. I'm glad we got there in the end. Sorry, that's probably me misreading the question there. So yes, the candles within our zones, within our UFO areas, will always be less than 50% of the candle is body. So more of it is wick. Even if that's 49.51, it's a software, right? It's technology. It has a very defined rule. If it's 50% or more of it is wick, then it will show in that UFO. If 50% or more of it is body, then it won't show as a UFO. So hopefully that makes sense. It's looking through different criteria as well. It's not just, you probably understand a bit of supply and demand if you've asked that question. It's not just looking at candle patterns or the size of the candles and things like that. It's looking at things like upticks versus downticks, volume in that area. It's running through loads and loads of different data sets to show us that. But one of the criteria is that, yes, it does have to be that pattern of candle as well. So it's not the only thing it looks for, but it is definitely one of them. Cool. Alrighty, so we'll cut off the stream to YouTube and Facebook, and when we continue in our closed group, guys, we'll go into calibration and how we can use this number with calibration to change the calibration of our UFOs, see if we can increase that number. If you have any questions, if you're watching us on YouTube, Facebook, you can email me if you'd like to, which is becky@traddictiv.com, or you can go to tradewithufos.com/Becky, get yourself a free membership if you don't already, and then come down and ask the question here in public so I can answer it in public, and then everybody sees the answer. We all help each other. Otherwise, guys, I wish you all that are joining us on YouTube and Facebook, I hope you have a great weekend. I hope you enjoyed this. I hope it was helpful. Those of you that use AutoUFOs on TradeStation, hopefully it gave you a little bit more insight as to how you can use that and refine your trade plan. For those that maybe don't do it, you've understood more about probability versus profitability, understood more about candle formations as well. And also, even if you can't do that within UFOs on TradeStation, you know you can do it on TradingView and how that number is got to. So you could manually do it yourself if you want to get that number as well. So I will leave you here, guys. I'll cut the stream. I'll continue in the closed group. I will see you next time. Have a great weekend. Happy trading, and see you soon. Bye bye.